Hi, I'm Hashim Kudsi, co-founder of Liwa Capital Advisors. I'm joined today by Abhijit Choudhury. Abhijit is an old friend and whom I've had the pleasure of sitting on the Risk Management Committee of National Bank of Abu Dhabi for 6 years. Uh, Today, I want really to have a discussion with him on what's happening in the GCC economies and specifically the UAE, given that he has spent really his career looking at credit from Arab Banking Corporation to National Bank of Abu Dhabi, and then living through the merger of National and First Gulf Bank, and then spending also some time with the central bank. Now he is managing his own firm, Athene, and I thought with our partners asking us about what's happening in the region, perhaps Abhijit is very much the person to understand what's happening inside the system. So Abhijit, thank you for your time, and perhaps the first thing to start with is really what is happening in the economy now versus what has happened in '08, because I think from the analysis it's very clear it is a different shape. Although, as I posted early this year, borrowing from the World Economic Forum about the Great Reset, I think also this is really a good opportunity for the region to go back and look at the things that need a reconsideration. The banking was really the first one, which obviously you and I have seen the merger of two sort of institutions here in the UAE. But I guess now there is more to be done in natural evolution. So if you can maybe just give me an idea of what is really happening today, and also the difference of that versus '08.
Well, good morning, Hashim. It's always a pleasure catching up with you. This prospect of meeting virtually and this conversation would have been inconceivable about 8 or 9 months back. We used to meet so often in our meetings and exchange issues on risk. Now, I think there's a lot which has been written in terms of the comparison between 2008, 2009, and the current situation. And today, 8 or 9 months into the pandemic, I think we are at an inflection point, given vaccine expectations, vaccine logistics, the whole situation in terms of the political realignment. I would call it tripolar between the EU, the US, and China in terms of politics, trade, supply chain, what have you. But given all of that, the reason why I'm touching on that is to look at some fundamental elements which are underpin the situation leading up to. And as a credit practitioner, I've always looked at to see what were the causes or what preceded the crisis. If you look at the situation in 2008, 2009, as we know, it culminated in a fragility in the banking system, a lack of confidence, issues relating to liquidity. Now, what happened as a result of that was this banking system capitalization needed to be significantly enhanced. You had the birth of new instruments, additional tier 1 instruments, etc., to boost the tier 1 ratios of banks. Additionally, you had regulation, which went into overdrive. Banks were required to in turn come up with recovery and resolution plans and living wills. And you had another element which came in, that along with regulation, accounting standards, there was a gradual confluence between accounting standards and regulation. The birth of IFRS 9, the whole issue and approach of looking forward and not looking historically. When you look at the issue relating to provisioning, it was an incurred loss approach. Now in the new paradigm, it's an expected loss approach. So you see the whole confluence between regulation and accounting standards. But underlying all of this, during this whole period from 2008 on till 2020, modeling was possible. We could model future outcomes. We can model provisioning. we can model valuations, we can model liquidity. And as such, today, at the start of the crisis in March, we started off with a banking system, which was well capitalized and liquid. And we have to remember that, because if we did not have that, and if we had a situation where, I'm not saying that going forward, we have to see how it all pans out, but obviously there was a situation where we started off with a banking system which was very well capitalized. And I know, having been there as a regulator and having been there on the bank side, the divide between banks and regulation and how there was this overemphasis on Basel III, guidelines on SREP of the regulatory side, guidelines on ICAP, Tier 2 capital, there was a lot of disquiet amongst banks to say that this kind of excessive regulation is actually impeding growth. Had it not been for that, we wouldn't have had. So that is my first element, to say that we were in an environment where at least we could model, we could do valuations, we could have numbers. And so that was one element. And the second was it led to a well-capitalized banking system. Now, where are we today? We wouldn't be having this conversation 6 or 7 months back, because we had recoiled into a state of shock. Today, we are 9 months down the road. Some prospect. I know during this period there have been issues relating to modeling how the pandemic is going to pan out. But from that situation, I'll zero in to the UAE and the GCC. Overall, as far as the UAE and GCC is concerned, as we are all aware, very well capitalized. Here in the UAE, our overall capital adequacy levels are at about 17%. And given that, the whole question is that how have we here in the UAE, for instance, the UAE has been unique in the first instance of actually identifying essential sectors, rising sectors, and then looking at those falling sectors which need to be supported. Just a couple of points, if I may mention, in terms of the essential sectors which have been identified by the leadership of this country, in terms of healthcare, in terms of food security, in terms of security, in terms of defense, in terms of SME. But it doesn't mean that the other sectors like hospitality, leisure, transportation, tourism are sectors which have to be supported during this period so that we can in turn go through the cycle. So what has happened here in the UAE particularly is that whilst there has been a realignment of focus and support for the redirection of resources towards sectors which are essential to in turn progress, at the same time, there were a lot of, the eye was not taken off the ball relating to institutional changes. And I'm going to later on in our conversation touch upon some of these elements relating to institutional changes which have in turn happened, making the environment within the UAE a lot more progressive. And one last point on this, and before we go on to more detailed aspects, is the aspect relating to the business. Now, one manifestation of a crisis, obviously, is you see NPLs in the banking system rising exponentially. The other element, as far as businesses are concerned, is the widening working capital cycle and the requirement for increased financing in an expanding working capital cycle. And to what extent is there in that interaction between the banking system and the borrowers, is there a true understanding that in this time of stress, how is this in turn happening? And how does the relationship in turn interact? So broadly, I would say that as far as giving you the backdrop as where it is relative to 2008, the current is obviously an exogenous event, which has impacted and literally had a blockade on demand and supply, the two fundamental elements of capitalism. And it's been an exogenous factor. Now the question is, how do we in turn react? And I would actually say that here in the UAE particularly, it's been unique in the sense of a redirection of resources and a continuation in terms of institutional changes and the ecosystem changes to support further development. And we can touch upon, if you wish, at a later stage on elements relating to SME, etc.
Yeah, which I think, kind of really brings me to the obvious question is that, so we know that, every economy has its own circumstances. So, for example, the most aggressive in dealing with the COVID has been really the US government. And reasons are obviously they own the printing machine. But more importantly is they really have constituents that they need to support. Now, the UAE obviously has different challenges in a way. You have a good sort of social fabric system in a way that you don't that the demographics are different, but also by the same token, I think you touched on the SMEs or even some of the other sectors, which I want to get your sort of view on whether they have gotten the support required to let to let's say get them to bridge to that sort of period that we are in, because otherwise that is showing up in the NPL, and then you have the multiplier effect in reverse. So what is happening to that angle? Because when I look at the general statistic credit growth, it seems outside the government GREs there isn't much of a credit growth. So what are you seeing in that at front? And also in a way, it's a bit a tricky situation, because as you said, you want to deal with the priorities, and the priorities, I think, they really tick all the boxes. Like people living here never really felt that gap, so as to speak, or disruption.
Absolutely. Hashim, I think that's a very good question, because obviously, I mean, taking the UAE into context, there are a lot of specifics. You mentioned the word demographics. Obviously, during this period, we've had a situation where businesses have been impacted. There's been unemployment. So there has been an exodus in terms of expatriate population, which has in turn impacted demand. Just as supply has also been impacted because of shutdown of businesses and lockdown, etc. Now, the question is that in this whole situation, how do you manage the crisis and at the same time be nimble enough to in turn to carry on with support for essential sectors? I'll touch upon a few elements. Unlike the US, where there has been a direct process in terms of stimulus and monies reaching across and subsidization, direct subsidization. Here in the UAE, the process has been a mix. On the one hand, obviously, you had at various emirate level, various concessions and stimulus measures in various forms, either in the form of relaxation on fees, charges, etc. But more importantly, a major component which has happened through the banking system. Namely, it has been more of a central bank administered process for the banking system to then provide the kind of relief to genuinely COVID impacted businesses. And I'll touch upon a few elements of the central bank's program. And, it's laudable that, one of the first countries within the GCC to actually move the whole process, move the needle, and come up with what we call the TESS program, which is the Targeted Economic Support Program, was here in the UAE. Not to say that the others were slow, others were equally fast, which also came around, but I remember it came out in April. And fundamentally, if you look at the components, the way it has been designed, there were 4 or 5 components. There was a component relating to providing forbearance and providing loans or deferment of genuinely COVID impacted borrowers. Now that amount was an amount of 50 billion dirhams, I'm speaking in UAE dirham terms, where the central bank provided direct funding to the banks. The track record of usage has been fully up to the mark. And recently, you would have seen in the papers, it was initially for a period of 6 months. It has now been rolled over for another 6 months. So one is direct funding and direct forbearance support. The second was to encourage the banks to in turn lend. Their capital conservation buffers were released. net result was the floor of minimum capital adequacy requirement was lowered, such that the banks had more space to lend. So that was the second component. A third component was their liquidity ratio was reduced. In other words, the total percentage of liquid assets which you're required to in turn maintain as a percentage of your total liabilities. Another very key element and a path-breaking measure was in the context of reducing and halving the reserve requirements which banks are required to maintain with the central bank. To that extent, the average cost of funding, as also liquidity available with the banks, would overnight a significant amount is released for the banks to in turn lend. In addition to that, there was relief in turn provided on capital requirements for lending to SME, as also in a very studied manner, the lending to real estate. Now, having said all of this is all very well in terms of looking at these steps. For it to be effective, where does the responsibility lie? I think there is a huge responsibility on the banking system to in turn administer and identify the genuine sectors and the genuine parts of the economy that require that kind of relief. It would be very difficult for the central bank to actually, in a very intrusive manner, central bank is doing its best to in turn examine that the monies are indeed and the relief measures are indeed going through to the right sources. So I think that is one element, and from what I gather, obviously as an outsider, that it is being administered satisfactorily, and which has in turn resulted to a rollover of the scheme for another 6 months. But there's fundamentally another element. We are talking about a very unstable environment, globally. In an unstable environment, estimation of future loss or expected credit loss is a difficult, and that is the reason why IFRS 9, which is fundamentally linked to expected loss going forward, is very difficult to model in the current environment. Now, the central bank has also come up with specific guidelines to in turn see how the staging, and you may be aware that there are staging criteria of stage 1, stage 2, and stage 3 in the whole process of provisioning. The central bank has in turn come in and provided specific guidelines in terms of that there is an issue in terms of provisioning and compliance with the IFRS 9 guidelines. Yes, that will be done. But in the meantime, when there is temporary relief, which is in turn provided to genuinely COVID impacted clients, those should be identified and broken down into what they call group 1 and group 2. Now that in itself is a challenge. Now, one last point, if I may mention on this particular part of your question, is that going forward, what's there in store? After all, at the end of the day, any kind of relief support from the central bank will find a point in time where it will be lifted. Now, in what way will the system be weaned off this support and this taper effect of the support and of the forbearance, and to actually do a through the cycle analysis by banks of their portfolios, of their analysis, of their interaction with their clients is very, very important. Hashim, as you know, the world over, in a situation like this, any entity which is leveraged with the stress which the system is in turn going through, the working capital cycle being widened, there is going to be stress in the system. So I think as far as banks are concerned, first line and second line, by what I mean is first line who are meeting clients, they need to have a much better understanding of their client's position in terms of their cash flows. Audited financials, or for that matter, management reports or management accounts are not good enough. You have to have more intrusive interaction with your clients to be able to do this. And this is an aspect which banks overall need to realign themselves in this new environment.
It's interesting you mentioned the point about what is next, because and how long would this need to be sort of continued. A couple of days ago, when President-elect Biden was choosing his team, it looks like that Janet Yellen is going to be the Treasury Secretary.
Yes.
And Janet Yellen obviously, sort of understands the system and lived through part of what you're speaking about. And in fact, in October, she did say something which is very interesting, is that, what has been done is great, but that has to continue to let the system sort of heal and restructure itself. And in the world of zero interest rates we're living in now, which obviously, you have seen, of course, rates at 10%. I have seen rates at 7%. That was the mechanism to kickstart an economy. We all got used to that mechanism. And now that is at zero. So now the only way to start an economy is for government to spend money, which means they need to print money, which means that somebody else has to be able to buy it. And the US being the reserve currency, they have that luxury, although there is a limitation to it, but maybe that's a problem down the road. For countries like the UAE and others who obviously have a peg to the currency, they benefit now from the zero interest rate, which is very much is required. Mm-hmm. But also, as you rightly said, they need to sort of, these issues need to be sort of looked at, and you roll over these programs within your ability to do so without jeopardizing the inflation component. Because again, I think the luxury we all have now is that, and it's in fact it's a sweet point. You can borrow at zero, and there's no inflation, so that is a sweet spot. But then that becomes a challenge if inflation starts going up. But I guess the question that I wanted to ask you here is so you went through the measures that the central bank did to flush the system with liquidity within its means. But then the question is, did the system did the credit creation really function the way it is, or is money getting clogged because some of the pipes are not as sort of flexible? So, for example, one data point which I think that now with the creation of the credit bureau and other things, and of course with the direction of the government leadership, to be an inclusive society. So in other words, I have the bank calling me to give me a car loan because of zero interest rates, and that is a good thing. But I think these criteria also should be really now expanded to the overall sort of people living in the UAE, to really now create a whole sort of a holistic credit growth environment, with of course the ability to have the systems to monitor these things versus dealing with the old approach of what happens if somebody leaves the country.
Well, let me address a couple of issues. You raised 2 or 3 very interesting issues. One is credit growth actually happening with all of these measures? The answer to that is, I think it's pretty flat at the moment. I think you've had the number one. Number two, I'll just give you a few dimensions and then answer your questions as far as what the 9 months figures of the banking system looks like. I mean, in the first instance, obviously, banks have been very conservative. The extent to which the 9 months provisions on a year-on-year basis has doubled. The cost of risk has actually gone up to about 130 basis points. In a low interest rate environment, obviously profitability has been impacted. There has been NIM compression. But a very important factor is that the liquidity obviously in the system has improved. The loan to deposit ratio is down to 84%. So you're talking about, as we speak right now, a system which is very well capitalized, banks which are very liquid. So the question is, when does underwriting once again commence? And in what manner? And is it going to go to the essential sectors? And through what means? few dimensions there. One element is, just to say, when the crisis hit, I'm familiar with one bank where I sit on the board, where in order to look at their preparedness going forward in a crisis situation, they had three channels. One channel was relating to the bank's infrastructure, business continuity, and so on and so forth. The second was relating to their capital and liquidity situation of the bank. That's the second channel. And the third was client interface, a new dimension of client interface. In other words, how do you in turn interact with your client? This whole concept of working from home. I was at a fintech conference, and in that fintech conference, I heard from HSBC that their wholesale platform has gone 100% digital, number one. Number two, their business continuity sites which they needed was not required because working from home proved to be perfectly efficient. So those elements relating. However, having said that, it has given rise to attendant risks relating to cybersecurity, financial crime, etc., for which you need to put in additional controls. So I think the whole dimension of approach and delivery of products, interaction with clients from the understanding of their financials, is obviously the medium will completely change. There has to be, in the short run, far greater interaction. And the approach in terms of a digital approach is far more efficient. Today, our conversation is far more efficient than it would be. Maybe I would have spent some time before and after having a cup of tea with you or during. So it's far more efficient. So I would say that where we are at this point in time is a situation where the banks are very well poised to in turn step up credit growth because of the situation. They put aside significantly on provisions and for the future. Now, in this whole process, the question is the institutional framework around the country, the ecosystem in the country, also developing where banks would in turn lend? And I'll give you one example. You mentioned about people leaving the country. A key element which has happened in this country where regarding decriminalization of checks. Because earlier on, if you had a bounce check, there was criminal proceedings, etc. So the whole question regarding loan documentation being subjected to criminal law is now shifted from criminal law to civil law, number one. Number two, there are a number of dimensions which are in turn coming in this whole process, and I just want to mention some of them relating to a centralized. You mentioned credit bureau, availability of data, availability of default statistics, with which you can in turn do more transparent pricing. The issue relating to collateral registry, you can actually, particularly smaller businesses who can only pledge their working capital assets. You have a centralized collateral registry where you can do it. You got from the government first loss credit guarantee to in turn support essential businesses. You got a situation where you got a national level receivables discounting platform where you can do supply chain, whether it is factoring or reverse factoring. Now, all of these surrounding elements, and of course, very importantly, in 2016, we had the bankruptcy law. The bankruptcy law has been rolled out. In 2018, the Financial Restructuring Committee has been created, which is very active, so that typically in terms of Chapter 11 type creditor protection workout, as also orderly liquidation, the whole enforcement environment has significantly improved. So what I wanted to say was that emerging out of this crisis with all of these stimulus measures from the central bank, plus ecosystem changes and the status of the banks, we are moving into a cycle where the banks ought to be more comfortable lending, particularly to areas relating to the backbone of the country. Today, Hashim, if I look at the so-called SME sector in the country, 75% is relating to 15% to services, another small percentage. You would want it exactly the other way around. You would want 75% to be manufacturing. So the moves which are in turn happening to create SME and small business as the backbone of the country. I forgot to mention credit insurance. I forgot to mention hedge management. I forgot to mention cash management products. All of these are elements. So I feel that to answer your question very simply, where we are poised right now in terms of the banking sector's standing and the institutional changes and the support of the central bank, banks would now need to revisit their banking, the strategy over the next 5 years, taking into account that this low interest rate environment, the future fears in terms of likely inflation, and to prepare themselves is the need of the hour.
Yeah. Yeah, I guess, I mean, with all what you've described now, I have to sort of put on my investor hat on, because this is, as you know, what we do on behalf of our partners. So there is this continuous discussion every week in the investment committee when we look at the monitors that we look at across the globe in terms of equity valuations and what have you. Khalifa and I always, sort of get into this debate in terms of the current pricing. Let's say in the region here, is the current pricing reflective of the fundamentals or not? And one area which I think which I think is missing here in the region is, so if I take the other extreme in the US, there is a distress, somebody wants to sell something, you have all of these people going around them to try to offer a price, and then something gets transacted. Now, of course, it's the nature of a city like New York or London to really be in that business. I wonder now if from what you've described here, is now the UAE or the region ready for something like that, where you really have a distressed fund? And in fact, now that you are sort of mentioning this, and given, I'm kind of going now memory lane when I remember the kind of discussions we used to have in the risk committee, where you're trying, to come up with a workout package for a borrower. I wonder if this is an area that is now ready to be born in the region, where you really have a proper distressed investing, where when there is a fund that can go to these people who want to sell. And by the way, distress to me here is not necessarily a bad asset. No, it's just that somebody needs to sell or rescue capital. Because after all, so we get asked by our investors and partners, what are the opportunities in the region? And as you know, we are a global investor. So we have said to ourselves, we will look at the whole globe, and where there are opportunities, we will sort of we will be going after them, but with the proper structure and right partners. And so do you think now is the time for such a fund really to take place? Or really more of these things happening, or even the idea of a good and bad bank, so as to speak?
Excellent, Hashim. Excellent. What I would say is a couple of things. If I look at it, I look at broadly, and I'm going to touch on this too, but I look at broadly. If you look at the situation here going forward, there are 3 dimensions which need to be sorted out. One dimension, as you said, is this exponential growth in NPLs. Yes, the banking system is in turn providing satisfactorily the provisions, but the fact remains that these NPLs need to be worked out. That is one dimension. The second dimension, as we spoke already about SMEs, and the third dimension is in terms of the whole area relating to digital and payments. But let's go to the first one. The banking system, loans, just to give you an idea in terms of the dimension, is about 1.4, 1.35 trillion dirhams, right? Our NPLs, gross NPLs in the system is about 6.5% to 7%. It's about 88 to 90 billion. Net of provisions, existing provisions, it's about 2.3%, 33 billion. Now, if it is today the percentage is 6.5, a 1% growth of NPLs gives you additional 13 billion of NPLs in the system. Now, you look at this amount of NPLs, the extent to which it is consuming capital, and consuming profitability on the bank's balance sheet. So it needs to be worked out. It's a challenge for banks because banks, in terms of their special assets, are obviously stretched. It's a challenge for the central bank from the point of view of actually supervising all of that. We talked about the IFRS 9 standards and so on and so forth. So against this backdrop, which we in turn spoke about, of an enforcement environment, I mentioned about the bankruptcy law, I've talked about the fast track dispute resolution, I spoke about a creditor protection type of approach. Question is, are we in an environment where there is a way for experts to come in with the benefit of experts who can in turn do proper restructuring and workouts? Is there value in identifying loans which can actually be worked out? It frees the banks from the perspective of them going on with their business in terms of lending the way in the national interest you want it to be done. You have a situation where you have got sectors which are slightly underwater who require temporary support. So you have the concept of debtor in possession financing, which can be provided to them, where you have workouts experts who in turn come in. And in all of this, what we are really talking about is a situation where valuation at this point in time is, I would call it, in a state of unstable equilibrium, for want of any other words. In other words, that you have got an emerging ecosystem which is very supportive of loan resolution, as I talked about bankruptcy law, etc. You're talking about a situation where the central bank has provided some kind of support and latitude on provisioning requirements. So to that extent, however, having said all of this, in doing all of this, there are a number of parties involved. If you're talking about a concept of a bad bank, good bank at a national level, or if you're talking about a BOT structure where you have a small corpus, where you have the players, where you got capital pursuing an asset class, namely loans in the system, and extracting value. Now, in doing this, obviously, there are technical issues to be sorted out regarding, title to collateral, loan transferability, licensing, eligibility criteria. Do you want to do by sector, namely for real estate, or do you want to do it across all sectors, etc.? So there are various ways in which you could skin the cat and slice and dice it. But definitely, if there was a time of a first mover advantage to in turn look at look at a prospect, in my humble opinion, having been there in the credit field, there couldn't have been a better time, because there is a confluence of interests. And I mentioned to you the parties involved. Let's assume let's take the capital part. As far as the capital part is concerned, you've got capital providers, whether they be government, whether it be quasi-sovereign, or whether they be private. There is the part relating to, and as far as these players are concerned, the structure of value of loan valuation and effective negotiation to come up with a particular value. It is an environment where that can be done. Second is the whole question regarding, if I look at it from the point of view of bank management. As far as bank management is concerned, you're talking about the remedial or special asset management departments being relieved of the load. If you're talking about, now, there are, Hashim, I have to say this, that in all of this, there are obviously a lot of moral hazards in structuring something like this, where banks continue to have a skin in the game, where there is a provision sharing agreement going forward, where there is a provision for a put back or a put option of the loan once it is worked out to the bank with a premium earned. So, there are a number of players obviously out there in terms of the bank shareholders. In terms of implications relating to dividend payout. There is the whole question relating to the bank management, as I mentioned. There is the whole question relating to wholesale borrowers who now have a process where, in a consolidated manner, you can have negotiation. You're talking about the central bank, and you're also talking about the government. So at this point in time, with the backdrop of where we are in the economy, where we are in the volume of NPLs, where we are in terms of the national interest of continuing to support the distressed sectors. Of course, it all needs to be worked out in terms of technicality, loan transferability. I mean, one of the ways in which loan transferability issues, etc., can be done is through a process of funded risk participation, where you still have the banks fronting the loans in the event that they retain 10% of their books. And then going forward, should the loan deteriorate further, there could be a situation where there is some skin in the game where the banks have also a share of the additional provisioning, which they then record as a contingent item. But I don't want to go into those specifics. The important element is today you have a process of data of Etihad Credit Bureau. You have data relating to collateral and collateral values. You have an enforcement mechanism. You have there is in the system. So in the event that the structure of this kind with capital needs to lever, that can also be done. And I think so, therefore, to that extent, from a return on capital perspective, commercially, as also solving a situation nationally, I believe is something which is really worth exploring.
And by the way, has any of these things been tested? Because, the typical, like when if I'm sitting across the table doing a due diligence on something like that, or if I'm asking a fund manager, have you actually gone through and tested something like this for me to decide to allocate money to you? So in that particular case, have these been tested since they've been enacted, or yet to be?
I think, Hashim, that's a very good question. Obviously, if you look at all the literature and do benchmarking of other countries and in Asia, etc., there have been AMCs which have been created, which have gone through. There have been ARTs, Asset Resolution Trusts, which have been done in India, or ARCs, Asset Resolution Companies, with that specific purpose, with a fair amount of governmental, backdrop. The AMC concept in Malaysia was driven to a large extent by Bank Negara. Now, I feel that you will get successes or elements which have not been that successful in various parts of the world. We are in an evolving environment, and the evolution which we are seeing is only positive. It is not retrogressive. It is going forward. So if anything, where we are today, whether we are talking about enforcement, whether we are talking about collateral values, whether we are talking about default statistics, key elements which would go into the valuation of an asset, that is only an emerging environment in this country, which going forward. So to catch those assets earlier in the day, subject, as I mentioned, to all mechanics in terms of loan transferability, mechanics in terms of there could be legal and besides those elements, the fact of the conceptually, it is only a situation where the underlying asset, which this capital, along with some funding, is actually buying, the prospect going for only be incremental value. Now, I know I speak with a lot of confidence in this. Execution and implementation is another matter, but I feel that I feel positive about it, because in this there is not just a commercial interest, but there is also a national angle to a resolution of the situation which we are in terms of otherwise it's a straight process in terms of banks progressively going forward, working out, and another reason is that in any workout situation, when it goes into a fund and where there is capital which is chasing the asset, the kind of rigor and due diligence with which underlying projections are going to be sensitized and analyzed will be far more efficient than the mass which is in turn held by a bank. So in a bank, you have got, whereas here when you got a fund, it's concentrated analysis, it's concentrated review and assessment of value with the sole objective of making it work work around. Now, I've been with a bank, and I know that the volume with you're in turn placed with just simply does not provide you with the latitude of time to do that kind of, to actually do future projected value.
Abhijit, I must say that what you shared with me today, in a way, because so I have looked at the COVID situation, although it's very challenging, and we all say we can't wait until the year ends, and the year, of course, is coming to an end, and hopefully the vaccine also will be made available. And while we all had our challenges, and we feel the loss of income for people that we know, and more so also people who lost their lives because of the pandemic. But I think it does really it gave us a wake-up call of the things that needed change. Probably we knew about them, but that got accelerated from the fintech to looking at our own well-beings and also the society that we live in. And I think perhaps this is an opportunity that we should not miss, in the sense that to look around us and to recognize what the situation we are in, the reality, so to speak. And so I guess from what you described, there is a reality that now banks are an integral part of the system. Credit growth is part of how the system functions, and the system has to evolve. And there are, of course, examples outside of here that one can draw conclusions from to make the system work going forward. And also, really, to a very important point, to leverage off the know-how.
Yes.
Like I think you are a perfect example of somebody who has spent quite a bit of his career in the region. He understands what's going on, and you are now also residing here. You set up your business here, and so blending your sort of know-how with also a fresh sort of mind with that wants to make things happen could be really a perfect opportunity to continue this natural evolution. And especially for a place, I think, like the UAE, that is open to the world, and with openness you hear ideas. Now I really think the success of any civilization has been to openness to new ideas. And so perhaps the evolution of the idea of creating a mechanism to exchange assets, its time has come to happen really in a manner whereby things move on. I have something, it's not working out for me, I can go and sell it and then go and start something else. It's not a bad idea that it didn't work out to me. No, in fact, I tried. And by the same token, there has to be that facility of making things happen. So great, to hear what you're talking about. And I think also it's good that you also provide more of this feedback to the different stakeholders. It's very important, I think, that people also hear of what needs to be done, so that this momentum continues, so to speak. Thank you for your time. We'll hopefully next time we meet in person, as much as we like the Zoom, but it is good to see sort of to get the vibes and the energy across.
Thank you very much, Hashim. It's indeed been a pleasure, and
sure.
Thank you for having this conversation.
Okay, thank you. Bye-bye.
Bye-bye.